This is Smart Investing with Mike.wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike.wren.
Hello, everybody. You have opened up another episode of the podcast of the Smart Investing Show, where we try to take the topic of investing. Number one, we try to make it easier to understand. Number two, we try to get you good, relevant information on each and every show. And thirdly, we try to be entertaining. So my name's Mike Wren, the host of the show, which is, the host of the show, but the person that makes the show funny. That's Mr. Chris Martin over here, the producer. Good morning, Mr. Chris.
How you doing?
Pretty good.
Yeah. I love this time of season in Spokane, where the political signs start taking over the orange cones.
Yeah,
you know, it's a shifting.
It is. You're actually right. Yeah. We're going from
the orange cones slowly disappear.
Construction season to political season.
No, I don't.
God, doesn't that sound lovely?
It's like 8 signs in this one guy's yard. It's like,
really?
All right. Yeah.
Okay.
But I've seen 8 cones out front of my house. So
did they repave it or something?
Yeah, they're doing something. I don't know. I don't pay attention.
Chris lives at the end of a very long dirt road next to a railroad track. No, I'm just teasing.
You're not that far off.
I've been to your house. I know I have to cross railroad tracks to get there. I look both ways.
Oh, okay. I was actually secretly looking for a post on our Smart Investing. I was going to give someone a shout out, but I can't find their name right now. But
somebody posted?
Somebody posted on our Facebook. You
Oh,
know.
okay. What did they say?
Let me find it, and I'll.
Is it that bad?
No, it wasn't that bad. He commented on our on us talking, and then versus how much investing there is in the show.
Well, did he like it or dislike it? He might have liked it. I don't know.
I think it was just kind of a laugh.
Yeah. It's
we're about 25-75.
Well, it's got to be listenable.
Well, yeah.
It's the listener, if we were on the radio, we could take a poll. How many people want to hear me complain about other drivers versus investment advice? It's probably 50-50.
Yeah. Let's throw something else in.
Tips on buying a car. Here you go. No, I'm just...
Right. And what to do if you're in San Diego Comic-Con. So why not?
Exactly. So, but I've got a lot of stuff on today's show, but that's investment related. Thank goodness, because it's an investment show. But I don't want it to be too dry because, like I said, for crying out loud, it has to be listenable. And
yeah, we can't do that. So today in the market.
Yeah. So I'm just going to kick it right off. Let's first start with a little lovely factoid, since the news and the internet is almost devoid of facts nowadays. So let's talk about the average annual return for the stock market, which a lot of people will interpret that as the Dow Jones Industrial Average, which is 30 large industrial companies. Did you find it or no?
I did find it.
Okay, go ahead.
It was just Ryan said that spend over half the show on financial stuff, though. 75-25 is the best mix. But other than that, you guys rock. What's
75-25? Does he want 75 on investments or 75?
I'm pretty sure that's the way
it
would lean.
You guys suck at investing, but you're funny.
Yeah, so I'm not taking any of your advice, but I do know how to make a costume for Star Wars now.
Perfect. So anyway, what I was getting back to is that, and thank you for the post, Ryan, the average annual return for a couple hundred years, and if somebody's thinking about the Dow Jones Industrial Average, the S&P 500, they kind of term that as the stock market in quotation marks. It has returned somewhere around 10% per year. That has been the long-term average, and that's kind of the earmark that used to be, frankly, used to be talked about a lot more than it is now. With all of the internet and everybody becoming, too smart for their britches, they're talking about other things instead of keeping things simple and to the fundamentals. So the fundamentals are that that's what those couple of indexes do typically for very, very long periods of time, longer than my lifetime or your lifetime of the person listening to this show. What does that tell us? Well, it gives us that it's like, okay, that's a pretty decent rate of return. It's hard to get that return in many other places unless you own your own business. I would imagine that the markup of candy bars and pop and beer at a 7-Eleven is more than that. I would imagine that the profit margins of a lot of privately held companies are higher than that, and they should be, because a person with a company like that is taking all the risk and they're running it, and so the profit margin should be higher. But back to the stock market. Most of my competitors and almost anybody that I would talk to, they don't really know where that 10% per year comes from. What makes it up? How come it does that? Here's why.
Mike, why is that?
Well, thank you, Chris. Let me tell you. Here's where it comes from. About 3 to 3.5% comes from GDP, gross domestic product of the United States. That means business being done. So if the gross domestic product is growing by about 3.5%, that means that, I guess on average, a lot of the very, very large blue chip companies are growing their business because more business is being done in the United States darn near each and every year. Now, a recession that everybody's talking about wringing their hands over like it's some Armageddon type thing. It's not. It's just a contraction of that GDP. Doesn't mean that the GDP goes negative. It just means that, let's say that the GDP was growing at 3% or 2.5% for a few years, and it backs off and only grows to 1%. That's what a recession is. Okay, it's just a thing. It's not Armageddon. So back to the long-term average annual return of a stock market index like the S&P. So if the average is 10 per year, about 3 to 3.5 of it comes from growth of GDP, gross domestic product, which typically runs about 3.5%. You get another 3 to 3.5% from inflation. Now, how does that work, you're thinking? Well, here's how it works. It means the cost of goods sold increasing, so the companies are increasing that cost to you, the purchaser. Like, let's say tires. Let's say the cost of rubber and producing a tire goes up. The company is not going to eat that cost. They are going to pass that on to you, the consumer. And it means that there is more money flowing through the company's hands. And if they are adept, they're going to be able to put out a net and capture some of that money for their profits. And if you extrapolate that to the very, very largest companies that are in these indexes that we're talking about, you get another 3.5% growth from inflation. So that gets us to 6 or 7% right there. Okay, maybe a little bit more, maybe a little bit less on average. So we're still shy of 10%.
Mike, what makes up the other 10%?
Not 10%. What makes up the remainder?
The remaining of the 10%.
Yeah. God, now we're good. Can you edit that out? Can you edit? I wish we could edit our stupidity out in life. Wouldn't that be nice?
You have a 3-minute podcast.
Let me rewind that. I shouldn't have said that in front of the in-laws. Wait a minute. They don't speak my language. They don't understand. So anyway, yeah.
Mike, what makes up the rest of that 10%? Really kicking in my interview skills.
Yeah, you should have some coffee. So it's a portion that nobody talks about that I've talked about ad nauseum on this podcast before. It comes from dividends of the companies. Now, what's a dividend?
Mike, what's a dividend?
Okay. It would be a lot funnier if we were happy hour somewhere and drinking. That's what you were doing right now, but since it's so early in the morning, it's like, I hear he's going to say it again.
It's also going to be a little slower. What's a dividend?
There needs to be people laughing in the background.
In the background?
Yeah, like an NFL game or something.
I was thinking more like it's going to be girls playing in the background. Hang on, I got glitter on the mic.
So dividends, what the hell is a dividend? I mean, what's funny is the name dividend, people understand the meaning of the word, but they don't understand how it affects them in life with investments. And the reason is because most of the investment industry, from my point of view, people have gotten away from owning individual companies. And if they own individual companies, they get a check from somebody like a McDonald's, like maybe a Johnson & Johnson or a Bristol Myers. So they're thinking, hey, Johnson & Johnson sent me my quarterly dividend, or DuPont. When they own a lot of mutual funds out there, the index funds, I'm not sure which S&P index fund, if they even have a dividend. I'm sure that it depends on
like I know.
Yeah, it depends on when they, because the S&P index does generate a dividend, but I'm unsure when and how index funds pay it, because I don't own any of those sucking things. So I don't know firsthand, but I don't even want to bother to look up because they're too freaking boring. But anyway, like a normal growth mutual fund that has a lot of growth companies in there won't pay a dividend, or might pay a capital gain at the end of the year. It's not even a dividend. If you've got an actively managed fund, maybe one of the good ones that's from a very old mutual fund company that's been doing it a long time, they tend to typically distribute a quarterly dividend, but it's so pissant small that people just kind of ignore it. But when you're getting it from the actual company, it carries a little bit more weight and meaning with the average human out there. So, the dividends, where do they come from? Well, let's say you've got a company run by me and Chris. It's a large multinational corporation where we make oodles of money.
Cars and costumes.
Yeah. And cash. No, cannabis. Costumes, cars, and cannabis, the 3 C's. There you go.
In a small little spot for my wife's dogs.
We would make a ton of money with that. So, let's say after...
Get hhigh, dress as Superman, and drive off in a Lamborghini.
Exactly. Or a Ford F-150.
We call that the Charlie Sheen.
Winning.
You want the Charlie Sheen special?
Exactly. So anyway, we're running our business. And so whenever our fiscal year is, whether it's June or whether it's December, we gather together with the other the other people that are on the board of directors. You know, like Bill Gates would be on our board,
of course.
Example. Yeah. You know, George Lucas, of course.
No, I don't think you'd... Oh, thank you guys for having me.
So we get together and we said, look at all this money we made. And we said, okay, let's actually be smart about how we're running the company. So we're going to take a chunk of that money, set it aside, and that's just going to be for contingencies and the type of business that we would run. I'm sure we'd have a legal defense fund, which means that we'd probably have to keep attorneys paid on retainer. Just a call.
If I get rich, that's going to be the first thing we're going to need.
Okay, so stuff like that. So stuff that some of the profits we have to keep for expected expenses for the next year. Then we're going to keep some extra money aside for maybe growth of business. You can't always depend on little Asian kids to make those Star Wars costumes, so we might have to buy a robot to do it. So we'd want to save some money for some capital improvements is what I mean. Okay. I'm trying to make it more fun than saying capital improvements.
It's going to be tough to have those robots make little hands for them, but okay.
Yeah. So anyway, we'll figure it out. Okay. So we keep
We've got George Lucas.
Yeah, we keep some money on the side. First amount of money is for contingency. Second amount is for improvements. Maybe we need to buy another factory out in Airway Heights where the people work cheap. So, it's something like that. And then that's not all of the profits. We have another section of the profits that we should just distribute to the owners. And Chris and I would be greedy, so we would just split it. But if we were a publicly traded company, we'd have to split it with all the other owners. Okay? In other words, we'd be declaring a dividend paid probably quarterly to the owners of our company. And that's what somebody like a Johnson & Johnson, a Bristol Myers, a McDonald's, and Exxon does. They have the board of directors that meets regularly, and in one of their meetings, they will declare the next year's dividend. Okay? This dividend that you get is a portion of the profits that the company generates. You get them because you're an owner. When you own common stock in the company, you get a share of those profits. And they typically pay them out quarterly. What's nice is this dividend is going to be an amount of money per share. It's not going to be a percentage of the share price. You can calculate it that way. You can say, hey, the dividend that I'm getting from XYZ company means that I'm getting about 3% on my money. You can calculate it that way. But truly how it's calculated, when you're getting the money, you have so many shares and you get so many cents or dollars per share, and that equals your check. It's very, very important that you realize it, because when your dividend is based on how many shares that you own, that means the dividend will stay the same no matter what the share price does. And the reason that that's important is because most human beings, remember when I said losing money feels 10 times worse than making money feels good? Well, what happens is the average human opens their statement and they see that their $1 million is now worth $800,000, and they're wondering, what the hell, what's going on? I didn't even see that $200,000. So that's the principle. That's the price of all of the companies fluctuating. And it does it all the time. The dividend is really nice to concentrate on because it doesn't fluctuate. It only changes when the board of directors changes the payout. And typically, these companies, the big blue chip ones that have been in business for so long, the vast majority of the time, they meet and raise the dividend, which is awesome for you. Them raising the dividend is raising your income that you're receiving as an investor in that company. And so if you think about it, you've got two buckets of money. You've got the bucket of money that's based on how many shares and the share price, and that thing's fluctuating every second of every day. And then you have this other bucket behaving where it's just based on how many shares that you own, and you get a stated amount per share. That's totally awesome because it gives you, the very emotional human being, a place to focus where it's nice and smooth and tender and loving and profitable, instead of the freak show that's the other bucket of money that the internet and everybody on TV and on radio and on podcasts talks about. What are you laughing at?
That you've got your wife on one side who's dependable and loves you and is always there, and on the other side you've got your side piece who's crazy.
Chris, what? God, Chris, you know what's weird about that is when Chris is...
I don't have the energy for a mistress. Let's put it that way.
Nobody does. So you've got these two ways that you can make money or are making money from an investment in an individual company. You've got the price per share fluctuating, going up and down, and you're hoping that it goes up over time. And then you've got this nice steady dividend that typically goes up yearly when the board of directors declares a new dividend payout ratio, and that's dependent upon how profitable the company was. But it also, think about how these board of directors and somebody's running a company, they're going to sandbag a little bit. They're not going to pay out everything that they earn. They're not going to take all the money that they have to go buy another company or buy a new warehouse. They're not going to put all their money into like a legal defense fund. So even if the company has a little bit less of a profitable year, on their books, more than likely, they're still going to have money left over from the prior year. So your dividend doesn't fluctuate as much with profitability as you might think. In other words, the folks that actually are on the board of directors, since we're humans, yeah, you can find the dipshits that are on there, but typically the board of directors are pretty good business people. And so what you have is you have them kind of protecting you, the owner of the company, in the down year, and then paying out extra when the up years come as far as profitability. So when the company has let's say McDonald's releases some new burger that doesn't sell, and it's kind of affecting how much revenue that comes in, which is, I know that it's a horrible example because McDonald's makes all their money from franchise fees and real estate lease payments that don't fluctuate, but I digress. So just for an example purposes, if that happened, your dividend isn't going to be hardly under pressure at all that year because the board of directors plan for it and they take their stewardship of the companies for the benefit of the owners seriously. Because if they get a bad reputation, they're typically on multiple boards and they're going to be fired off of them. So there goes their easy money. So they're really, most of the time, they're trying to do their best. And that's good for you, the business owner. So that's pretty powerful thing when you have a third of the performance, typically, of the long-term average of the stock market index, a third of it coming from dividends. That's a pretty big area to just give away or not even talk about. But that's what's happening, and that's what's kind of always happened. Since that dividend doesn't fluctuate with emotions, well, there's nothing for the news media to talk about because it's not clickbait. It's not, being a weatherman in San Diego. Yeah, it's not a bus full of nuns going off a cliff or something like that. It's not, there's nothing to catch your attention. They declared the dividend, it's going to be paid. Next page, okay? So there's no way to spin it. There's no way to embellish it. It just kind of happens. So it gets ignored. And it's one of the most greatest things out there because not only that it's consistent, but these companies, they have amazing track records of raising their dividend. Okay, case in point, Johnson & Johnson. People know that company. Right now, the dividend for Johnson & Johnson, I believe, is $3.80 a share per year. And let's see. Hold on. I'm looking at my computer right now, so that always makes really good radio, makes really good.
Go ahead and type it up there.
No, I already did. Yeah. So anyway, their dividend right now, I'm trying to remember. It's either $3.60 or $3.80 a share right now. Okay. What was it 20 years ago? $1. 20 years ago, it was $1. So in 20 years' time, that dividend has darn near quadrupled. It's darn near gone from $1 to $4. It's, in another few years it'll be there. So that's pretty darn sweet. That's called increasing income, everybody. Increasing income. Let that just sink in for a minute. My industry doesn't talk about this. So when you own a company over 20 years that's raised their dividend that often, why in the hell would you sell it? Why would you sell it because somebody out there says that or you read an article that some dip wrote?
You've already said the word one.
Yeah, that wrote that said you should have a certain amount of bonds by the time you retire. What the hell does that even mean? They don't define retirement. They don't define what type of bonds. They just kind of throw it up out there, and somebody like me throws up in my own mouth every time I hear that crap because it's completely off base. It's kind of like saying, "Oh, don't go outside with your wet hair with your hair wet because you'll catch a cold." Yeah, like a virus just falls from the freaking sky. It doesn't happen. Okay, it happens if you touch something, and the virus is on your hand, and you don't wash your hand. That's where or somebody coughs in your face. That's where it comes from. Viruses just don't fall from the sky, and people shouldn't just automatically read stuff off the internet and then ask me if it's true. Of course it's not true. It's written on the internet. So, I mean...
Wait.
Oh, no.
So you're telling me...
We just burst Chris' bubble.
Things on the internet can be fake?
Or at least a little bit untrue, or maybe not researched. So, bond portfolios are called fixed income. They pay you a fixed rate of interest for their life. That's definitely not called increasing income. You could very much say a good investment in companies that pay dividends, you could call those not fixed income investments. You could truly call them increasing income investments. But nobody calls them that, even though it's factually true that the income from many of the companies In the Dow Jones Industrial Average, damn near all of them pay a dividend. I imagine maybe Facebook's in there. They don't pay a dividend. Google, barely. But Amazon doesn't pay a dividend. But the other big behemoths like a Boeing, they sure as hell do. So you could truly call those investments increasing income investments. And if you did that, people's heads would spin. Why are you calling them increasing income investments? The price per share just went down today. That's not increasing income. And you could hear the blather come from their mouth. You could see the foam because they just don't understand. Investing is not what happens in a day or a year. It happens over multiple years. And so if you own a really good company over multiple years, you're typically going to get some really good dividends, and you're going to get some good dividend increases. So when they're increasing your income all the time, and you're comfortable with the type of business that they do, I submit to you again and ask this question. Why would you sell? Why in the hell would you sell? They're increasing your income. Why would you go from something that's increasing your income to something that will never increase your income? Just because my industry says you should, or some girl that wrote a book that can't find her butt with both hands from Harvard or Columbia, you name your Ivy League school that you want. You know, most of the people that graduate from those, I wouldn't have them run my damn 7-Eleven. So there you go. Why not? It just boggles my mind. So getting back to this, do some of your own investigation. I brought my little Surface here to do the podcast to give you an idea of how to do it. Everybody probably knows, if you're listening to this podcast, you know what Yahoo is. You go to Yahoo, and then you go to Yahoo Finance. And when you bring up the Yahoo Finance page, about middle to lower third on the right-hand side, it's going to be a little box that says, quote, lookup. You can type in the name of the company that you're interested in. You could type in Campbell Soup, Johnson & Johnson, McDonald's, Microsoft, whatever. When you type in that quote, it's going to bring up a summary of the company. And right then, the summary of the company is going to tell you if they pay a dividend. And I will do it right now. When you're typing in that box, it's going to autofill below. And then you're going to see about the middle of the page a bunch of blue words. It's going to say summary, company outlook, the chart, things like that. So the summary is going to give you the summary. And when you look at the summary, it's going to tell you what the dividend yield is, if there is one. All you need to know is if there's a dividend yield. That's telling you that there's a dividend that's paid. So you can go about the middle, lower third of the page. You click on historical data, and that's going to bring up, guess what? Historical data. And underneath that, it's going to offer you a time period, and then you can select the time period. So you can go back a year, you can go back 50 years, however long the company's been in existence. This is one thing wonderful about the internet. And then you can click show historical prices or dividends only. And then you click the button that says apply, and boom, it applies it. It's wonderful. So you don't have to take my word for anything. You don't have to take anybody's word for. In a very short amount of time, an hour, a couple, 3 hours, you could look up quite a few companies that you know the name of. You could see what kind of dividends that they pay. And guess what? You can see what their dividend history has been like. So right now, Microsoft pays 46 cents a share quarterly. Okay? So you can easily go to your calculator, 46 times 4, that's $1.84. They pay $1.84 per share. So you can go into the time period and you can put in a different time, and you can, instead of start date of 8/31/2018, 8/31 of, let's say, the year 2000. Let me plug that in.
Let's
Done.
go back to the year 2000.
And then apply. And then what it's going to do is you can scroll down back to the year 2000. Looks like in the year 2000 they didn't pay a dividend. They started paying a dividend in 2003. And they used to pay dividends kind of lumpy. They'd pay a small dividend and then kind of a lumpy big one. But there you go. They started their dividend at 8 cents a share. And then they raised it to 16 cents a share. And now they're paying $1.84. I don't know, but that sounds like a pretty damn big increase.
You know what? Sounds like they're doing pretty good.
Yeah, you go from a dime to $1.84. I'll let you do the percentage math. And after you figure out that percentage, try to find yourself some sort of annuity or some sort of mutual fund that has that sort of performance. And by the way, doesn't have any damn thing to do with the price. This is just the dividend. The price is done pretty well. If you really want to torture yourself, then you go back up and you select don't show the dividends, show what the price was back then. And then you'll be pulling out your hair, and then you'll know the meaning of frustration. Because
that's what we want to do on this podcast, is frustrate you.
Well, no, but then you'll know why Warren Buffett says his biggest mistakes have been companies that he didn't invest in. That he was looking at them and decided not to, and then it's like, damn, it's like the guys like me that like cars. It's like the car that you wanted to buy, never bought, and now it's worth multiples. Or you used to own a really nice, rare Porsche 911, and you sold it to pay for kids' college, and what you sold it for was 1/8 the value of what it is now.
On for like maybe a year, it would have.
No, just like 4 or 5. Selling a car for $12,000 and now it's worth $140,000.
Thanks, kids.
Yeah, things like that. So anyway, maybe it was 14. I don't even want to think about it. So anyway, that's the meaning of frustration. Coulda, woulda, shoulda. When you look at these numbers, you're going to get a lot of the feelings of the coulda, woulda, shoulda. And it's also what I think about when I'm investing, when people are worried about whether the price per share is going to go down because there might be some stupid recession, or all these fanciful worries that basically are not factually true. They're emotionally true because your emotions are emotions, but factual world stuff, not true at all. And I mean by how harmful it is. Recessions do happen, prices go down, but people have a weird take on how harmful that can be. That's why I try to counsel people, why don't we, instead of worrying about the price going up and down, why don't we make sure that, number one, that I try to reassure you and let you know that the downs are temporary and the ups are permanent with these price declines and price swings and price increases. It happens all the time. Try to get you, the investor, to realize that it doesn't matter because a decline is temporary in nature. They always have been. That's a fact. It's not inflammatory. All the price declines in the stock market, the S&P 500 in the United States, all of them have been temporary in nature, which means it leaves them almost meaningless. It almost puts them in the category, who gives a shit? Because that's temporary. It's going to recover. You just don't know when. So quit worrying about it. You don't know when the big snowstorm hits in wintertime. You're going to get one. You just don't know what month, what day. You don't spend your time worrying about it. Maybe you do. I don't know.
I think that would be a great segment on the news. And now here's Donald with Who Gives a Shit. Thanks, Mike.
So anyway, so that's the first thing. So once when I try to powder that emotional, Vietnam that lots of people have, Vietnam meaning an unwinnable war of their emotions, then I try to say, why, instead of concentrating on that stuff, why don't we concentrate on companies that you would be really comfortable owning? And how about we kind of sift those companies down, not only the ones that you'd be comfortable owning, but let's own some ones that pay a dividend, and let's own some ones that have a good dividend history, let's say for 20, 30, 40, 50 years. And let's add on top of that companies that have increased their dividend all those years. That sounds pretty good. You can't control the price going up and down, but you can control what you own. And you can control how you behave. That sounds pretty reasonable to me. And mark my words, when I'm dealing with clients and people need that reassurance, because we all need reassurance at some point, some people need more reassurance in their marriage, in their personal relationships. They like more pats on the back. It's never the wrong thing to tell somebody that they're appreciated. It's always well received.
Yeah, it's just in the way you say it. Oh, no, you're appreciated.
Yeah, there is that.
There is a way.
There's a way to mess it up. So when I'm dealing with clients, I realize that it's always well received to provide some reassuring words, some reassuring facts, just some reassuring conversation. So when I'm doing that, after I make sure that the client knows that I care, that they are, not feeling so great, that they're feeling a little bit down. Everybody has down days. I immediately go to the dividends. And let's look at what the dividends were paid to you 2, 3 years ago, 4 years ago. I don't ever have to go back a decade, because somebody that's been investing a decade and hasn't panicked and sold out, they get it because they've seen the dividends increase.
You're just reassuring.
Yeah, but if they've been an investor not for that long of time, then I'm going to reassure them, and I'm going to say, hey, let's look at these dividends. Look at that. Just like I told you, yeah, it's been consistent, hasn't it? Yeah, it didn't change as much as the price. See what I told you? You can concentrate on that because it's real. It's not fanciful. There's no way to spin it. It's in your money market. It's money that's actually, been paid to you and flown in and it's come into your account. Isn't that kind of nifty? Well, yeah, and it's like I tell clients, if we're going to concentrate on a bad fact that the price of their portfolio is down, which is always going to happen from time to time, then let's also concentrate on another accurate good fact, that their dividend income has been consistent and has in fact gone up. You see how it kind of takes the high pitch emotion out of it. It's like, yeah, I know that you are unhappy about it, but if you're dealing with me, I told you that market declines and your investment portfolio value declines are 100% guaranteed. It's going to happen occasionally. You're for sure going to look at your statement a few times over the years, and it's going to be down, and you're not going to like it. Absolutely guaranteed that it's going to go down. So, but it's not going to stay down. And then move on to something that's also absolute. Look at the dividends that you have garnered over time. Pretty darn cool. And you see, when you start talking in those ways, when I'm not trying to feed into the emotions, but just try to acknowledge them and address to them, and then move on to the same topic, it helps reduce the anxiety. Because guess what? When your account's going up, oddly enough, you don't have that much anxiety. Isn't that weird how that works?
You don't get any calls? Mike, my stuff's going up. I don't know what's going on.
Yeah, I'm having anxiety because nothing is here to worry about.
It's going up too fast.
Yeah.
I don't know what to do.
Anyway, that's pretty much it for the show, Chris. You can end with a joke.
I was just going to say, you kind of remind me of, there's a scene in Ferris Bueller's Day Off
okay,
where they're just outside the restaurant, and he looks over and he sees his dad talking to a client, and they're getting into a cab, and he's like, no, Mike, you got to understand, this is what we need. And he's like, okay, maybe you're right. And he's like, oh, yeah. And then as soon as the guy gets in the cab and Ferris Bueller's dad shuts the door, well, yeah, exactly, shuts the door. Bonehead. You just kind of remind me of, no, everything's going to be fine. And then you hang up the phone. Bonehead.
That may happen. I'm not going to admit to that here on this podcast.
Oh, no.
That may happen. And if it happens, it's not because of the person. It's because it's probably the 7th time I've had that.
I was going to say, because all of the lights are blinking on your phone right now.
Yeah, exactly. That's the only reason. It wouldn't be based on the client. It could be, but it wouldn't be. It'd just be, well, that's the 5th conversation. But I have an internal rule. If I have 2 of those conversations in a row, I leave the office and go get something to eat.
Get some sun?
Yeah, no, I go get a coffee. I go get... if it was in the old days, I'd probably go outside and have a smoke. But I never smoked. I'm talking like 1950s, like Mad Men. But that's not me.
You go out on the ledge, have a smoke,
yeah.
Back in.
So I don't go get a smoke. I don't go get a Manhattan. I'd probably get like a Butterfinger Aristas, maybe some sort of
something
nice
different
ice.
That'll kill you.
Yeah, some nice iced coffee, and then I come back to the office and start returning messages.
Because it's 9. You don't have a drink until 10.
Right. Thanks for
ridiculous.
that. Yeah, we've got to keep civilized here.
Well, yeah. Come on. We're not cavemen.
Well, we can.
We can't.
Anyway, thanks for listening again to this podcast. We'll try to be back again next week, same place, about the same time, for wonderful information from Mike and Chris.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.